Abby, good to see you. We have a weighty topic today. 3 ways to reduce your IRMA for Medicare Part B. If the Social Security Administration considers you a high income beneficiary, you will pay a surcharge known as the income related monthly adjustment amount. First tier starts with modified adjusted gross income of more than $103,000 if you are single filing, and it jumps to $206,000 if you're married filing jointly. So, Abby, let's start at the top. How does IRMA work and what could cause this penalty?
Yes. So IRMA, if you know what IRMA is, it's probably because you've been hit with it and you didn't expect it, unfortunately, and it was one of those really bad financial surprises. Otherwise, most people have no idea what IRMA is. It sounds like the name of a great aunt or something.
Right.
But we love our acronyms in finance, and so it's called IRMA, or income related adjustments, as you said. And so this is for Medicare beneficiaries that have what is considered high income or income over these thresholds. So there's a certain amount that you will be essentially, it's kind of like a tax or a penalty, if you will, if your income is over these limits. And they are what's known as cliff thresholds. So if you are $1 over these limits, you're going to be paying that extra amount. Now, the important thing to know is that there's a 2-year look back. So for example, for 2024, they're going to look at your income 2 years ago, so in 2022, to see if it's over these different thresholds. A lot of times people are like, but wait, I was working 2 years ago. My income is maybe less than that now. There are ways, there's a form that you can file, a life-changing event is what it's called. And you can let them know basically like, yes, my income was over these limits 2 years ago, but my life's changed. I've, been let go, or I've retired, or something drastic has changed. There's a list of categories there, but that's essentially what it is. So it's a tax or a penalty on your Medicare premiums if you are a high income beneficiary.
And then just a quick run through with that number, it's anywhere from $174 a month to $594. So that's quite a jump.
Right.
So let's talk through those 3 strategies then to reduce your IRMA. And the first strategy is Roth Conversions. Why?
So Roth Conversions are going to take taxable money that is tax deferred, but it's taxable when you take it out. So that's your 401ks, IRAs, those sort of accounts. You've never paid tax on those. As soon as you start using those, say you don't have a pension, so you're going to live off of those accounts, every penny that you take out of that is 100% taxed at ordinary income. However, if strategically, before you get to 65, before you start Medicare, do Roth conversions while keeping your tax bracket in mind, not kind of blowing up your taxes, but doing it strategically, you can move at least a portion, or hopefully even a majority, from tax deferred or tax forever to tax free. And that means also you have a lot more control over when you take those distributions and how you take the distributions, because what we find a lot of, unfortunately, kind of the old rule of thumb was don't touch your 401ks, don't touch your IRAs, let them grow, defer the taxes. People were really afraid of taking withdrawals from those accounts because there's a big tax bill associated with it. But what happens is when they get to needing that, or when they get to RMD age or required minimum distributions, they've not only built up the IRA or 401k balance, but they've built up this tax bill. And if they have to take a very large RMD, then you're going to have to pay IRMA on top of that. If you have Roth IRAs as well, or at least a more balanced approach, then you have tax-free income, which does not count towards the IRMA penalties.
Right. And you don't have to take the RMDs from a Roth, right?
Right. Yep, exactly.
And then next you say open and invest in a health savings account.
Yes. So an HSA, as it's more commonly known, or a health savings account is the long name for it, is a triple tax benefit account. So you get a deduction for contributions, you get growth that is tax-free, and if you do qualified withdrawals for medical expenses, that's tax-free as well. So
Wow.
the only accounts that is triple tax benefits, which is huge. I mean, that's so powerful. A lot of times, previously they were not as popular. They're gaining popularity. You have to have certain medical insurance to be able to qualify, unfortunately, for these types of accounts. But
Mhm.
it's really important to look into, especially for people that are wanting to retire early. So before 65, maybe even 55 or something like that. This type of account can play a huge role in bridging from, well, whatever, 50, 55, 60 to 65 when you can start Medicare.
Mhm. And last, you say consider qualified charitable distributions.
Yes. So this is going to help with, again, it's kind of the same concept of a Roth IRA, but instead of moving it from your tax deferred account to your tax free account, you're going to move it to a charity that you're really hopefully passionate about. So what you do, as long as you're 70 and a half, you don't have to be RMD age anymore. You can be 70 and a half and above. You can take a portion of your IRA and you can send it straight to the charity. So you remove yourself as the middleman, as I like to say, send it straight to the charity, and it does not count as taxable income. Whereas any other withdrawal from your IRA is going to be taxed as income. Now, this is especially powerful when clients have to take RMDs, maybe even very large RMDs. So either all or a portion of their RMD can be satisfied using a QCD. So take yourself out as the middleman. Instead of you receiving your RMD and then sending all or a portion to charity, send it straight to the charity. And you don't have to pay tax on it. The charity doesn't have to pay tax on it. And it reduces that from your taxable income.
Right. I really like that strategy. It's such a win-win for everyone.
Mhm.
Abby, clearly some proactive planning necessary with these strategies. If they'd like to talk to you about getting these, considered or in place, how can they reach you?
You can always give us a call at 678-442-0255 or visit our website, theretirementfamily.com. We have videos like this and a ton of other topics on there that hopefully you'll find interesting. And then send us a message. Let us know what specifically is on your mind, and we can set up a 15-minute introductory call where we just talk about kind of what's going on with you and how we might be able to help.
Great. Abby, thanks so much for your time today. I appreciate it.
Thanks, Erin.